All right, is everybody here? Is everyone excited about a great Tuesday?
Tuesdays are the best.
So welcome to Foresight's Fireside Chats. This one is on capital raising. We have an absolute fantastic set of panelists for you today. We have Mark Reynolds. He's the founder at Meta Capital. He's seen hundreds, if not thousands of deals he's participated in. We're looking at, evaluating, helping them get across the line. So fantastic to have his kind of viewpoint from that side of things, as well as Vicki Knott. She's the CEO at Crux. And so she has raised capital. She's been in the trenches. She's done the hard work. She's here to share some of her experiences, what she learned along the way, probably some of what some fantastic mentors provided to her, what maybe some other CEOs who guided her, as well as her own the scars on her back of trying some different things. So really happy to have them. This is going to be moderated by James Chapea, who, again, from the viewpoint of you couldn't find a better person to do this. James is currently working with small companies to help them raise capital. In the past, he's worked at VC firms like Chrysalix, which exclusively invests in clean tech ventures. He's worked at Goldman Sachs. He's got a ton of experience in this space and absolutely brings a wonderful viewpoint to him. If you're not aware, James is also one of the moderators for our investor readiness training program. If you're looking to raise money in the future and you want to go through sort of a basic training, I know this is going to be a great 1 hour chat about it. That's going to extend it out. That's going to leverage some of the information that we've distilled out of James into some readings and some videos. So that's a lot of fun and a lot of value as well. In case you don't stick around all the way to the end, do want to mention coming up next month, we've got a little CEO 101. We're going to be talking to a panel of people there about some of the things they've learned about how to balance all the different requirements you have. And we do have also a little info session on March 18th if you want to learn more about our programs, including that investor readiness one I mentioned. But we do have a cohort starting at the beginning of March. So go to our website and check that out. And last up, we have the BC Clean Tech Awards for those of you who are interested in what's going on in the BC ecosystem. It's great to get out and cheer on some of the successful companies, the supporters there. That's going to be on March 24th. Without too much, that was a lot of ado. So without further ado, I'm going to turn it over to James.
Hey, welcome everybody. Looking forward to another one of these fun sessions. Hopefully you guys have brought yourself something to drink while we sit by the fire and get to listen to the stories from Mark and Vicki. I'll let them to give you a little bit of their background momentarily. One thing that we'd like is, if at all possible, if you got questions, throw them in the Q&A at the bottom. I know some of you will just put in the chat, but if you could throw it in the Q&A, then we could actually respond to you, some directly just online, and some will raise the questions amongst everybody. So with that, let me turn it over to Vicki and let Vicki introduce herself, because she's gone through this journey of what it's like to raise money. And what we want to get at is the do's and don'ts, and really, you know, one of the things Vicki and Mark are going to talk about is how the things could be actually really bad. So let's make sure that we can deal with the things that you want to make sure that you don't do. Vicki, welcome. Thank you for joining us.
Yes, thanks for having me. So quick intro, or the elevator pitch, James, as you love. What Crux SCM does is, we automate control room operators, procedures, checklists, and rules of thumb. So I love to draw the parallel to autopilot. You're not going to get in a plane without autopilot software, but you're not going to get in a plane without a pilot. Yet our major critical infrastructure globally does not have autopilot software, not consistently anyway. So that's the problem that we're solving. The value prop of why that's important is it increases the utilization of existing energy assets, thus the revenue for those companies, and thus efficiency. Efficiency is green. So that's the 30 seconds for you, James. Did you want any more?
No, that's great. They can ask you more questions if you want to get at it. Mark, you've actually got very similar to my background. You've been on the sell side and the buy side, so you've punched people in the face and got punched multiple times, so you know what this is like. How do you characterize this and give us a little background on what you're doing today?
Sure. Yeah. I mean, just a quick background from a career perspective, 20-year finance professional and that entailed both being an investment banker, an equity research analyst, and right now being a founder and a principal of Meta Capital Partners, which is a merchant bank. And what that really entails is both providing advisory services as well as allocating our own capital into industry verticals that we like and see opportunity in, which can range from healthcare, technology, both SaaS and HaaS businesses, the medical space, and business services as well. So from that perspective, we've made 7 investments. From that, and they can range from startup, pre-revenue to more established businesses. So really, from my perspective, having seen and raised capital, there is definitely a life cycle of companies. And when you start from scratch, you are truly investing in founders. And I think that's one area that Vicki can talk about. And then as you get further along, it's really defining your processes and clearly articulate the long-term vision of the company. So, I think that's where we're at. And I think on both sides of the table, you can get your face punched, and it's a lot of work. And I think the key thing that I think we can convey to people interested in raising capital is some good takeaways that I would say are good rules of thumb to move forward with raising capital. And having a tenacity, I would say, is one of the key ones, because you are going to get punched in the face a lot, so you have to get back up and keep going.
Mark, thanks. I totally agree with you. Vicki, on that, what are some of your okay, so you've experienced that, and I know we get carrying on that theme, we get bloody noses once in a while when we're going through this, and I'm sure it's not a lot of fun. But what have you seen that moves the needle as far as avoids some of those things? How do you find those investors? How do you go through them, and what's the process that you've done to move the needle for yourself? Because you guys have been very successful in raising capital.
Yeah. Yes. So, a little bit more background, because I think the story is interesting and highlights on, the fact that you need sponsors. You need to find those people who really, really believe in you and the vision. So, myself and my co-founder, we're from oil and gas, very much deep tech engineers is what folks would call it. It's I'd never heard of venture capital. I'd never heard of startups, never even heard of a sales pipeline. So we did go through an accelerator program, which is great. Foresight, these programs are fantastic, especially for folks that really have no concept and come from, I was a field engineer and a control room engineer in oil and gas. So we went through this program, Techstars, and I met a mentor there. His name's Jens Lipinski. And he said, well, I'll invest, but I'm going to teach you how to raise venture capital. And so I'll only invest if you let me, if we meet every Friday and I teach you how to raise venture capital. So that was very, very pivotal for us, for learning how to do it, why it's important as well. Because I think when you're, especially if you're an engineer coming out of heavy industry of any sorts, or, or highly technical, you don't really understand the business side as much as you think you do. You're smart and everything, but I didn't understand it. So having that sponsor was really important. So he showed me how to set up the sales pipeline, right? I was going to put some slides together on this and I actually forgot, but I can share this after as well. So really what you do is you have your list of investors. You need to be able to get warm intros to every single one of them. So the first time I did this, I had 85. So 85 folks who I knew I could get warm intros to. And the way to figure that out is, if you don't know directly, LinkedIn, who's your second connection, right? And then ask that person for a warm intro. You make sure you have your forwardable intro as well. And this is all, and what I'm speaking about too is venture capital. I'm not speaking private equity. I don't know that world. But you have your forwardable intro. You do not attach the deck. I'm going to repeat that again. You do not attach the deck when you're trying to get meetings with venture capitalists. PE, whatever, that merchant bank, Mark can fill us in, that might be different. But venture capitalists, you need to get the meeting. And if you give them the deck, you're giving them 1,000 reasons to say no to the meeting. So yeah, James is
yeah. It's my saying, never answer an obvious question.
Yeah.
And to your point, they let them ask you for the deck, but don't give it to them until they've asked. You're right.
And then when they ask, you can say, how about we have a meeting and I go through it with you? And then you're like, great, then you got the meeting, right? And so like typically a lot of entrepreneurs, or me at least, like I'm much more appealing in person than I am over a slide deck, which I feel like people in general are much more appealing in person. So getting that meeting.
Vicki, in your forwardable intro, do you have a few tidbits that are relevant to the story, right? You're not just going totally blind.
No. You have like you can literally Google like good forwardable intro for venture capitalists, and it gives you like perfect formats. And you may want to iterate it on it, but like you want to put your traction, if you've raised any money to date, maybe how big you are as a company, and then your market size, of course, because venture capital is very interested in market size. And like some people get very overzealous on that. Like it needs to be realistic. Like if you say that your market size is like, 500 billion in Canada alone, like that smells wrong. Like don't do that. Right. So yeah. And if there's anything else that's like very unique about your company, so maybe it's like, maybe you're in a busy space with lots of competitors. So you need to make sure that you're differentiating really quickly, right? Like why you're different. So be cognizant of things like that. But yes, good question. Good elaboration, Mark. So once you have the forwardable intros and you're sending those out, then I set up a spreadsheet. So in your horizontal, like your vertical, you have every single VC you're going to meet with. I had a column that said, did I get a warm intro or not? And then I had a column that said, who's that warm intro from? So that I could keep track of it all. And then did I get a first meeting? So it turns into just like yes, no's, right? But that's the easiest way to track it. And then that's a way that you can kind of, keep your head around it. So it's first meeting, second meeting, first meeting, digging in is usually what I do. Sometimes you'll have a second meeting, sometimes you won't. Then you'll have like partner meeting and then term sheet. So it's really quite simple. Like it's just first meeting, second meeting, digging in, partner meeting, term sheet. You don't need to track anything else. And then notes. So, especially if some folks are real special, so you like to take notes. So that's how you're running the process. And then another key thing that entrepreneurs, I tell them, they verbally say they agree with me. I don't think I've had one Canadian yet actually do this. You run it like a tight and tidy process. So you have your spreadsheet set up, and then you try to hit all 85 of those in the first week. That might sound overwhelming, but the whole goal is you start creating momentum. So every time that you're in a meeting with a VC, you're like, hey, you're my third VC today, right? So you create momentum without having to fake it or having to, like, I can barely lie to save my life. So like you're not having to create artificial FOMO, you're creating real FOMO because they know that you're moving through so many different investors so quickly. So that's kind of like the overall description of the process and how to run it. So the first time I ran that process, I did in 9 weeks. I had a term sheet. So again, when I talk to founders in Canada, they're like, oh, 3 months, 6 months, 9 months, a year. And I'm like, then you're not doing it right. But that's if you're raising from venture.
So Vicki, you actually raised a point. And I want to get Mark's thoughts on this because you said FOMO, and some may not actually know what they're talking about. It's fear of missing out. Yeah. You're trying to create that excitement that says, I do, like, if I'm only going to do 1 or 2 deals this year, I better be doing this one. Mark, when you get so how do you respond to a cold call versus a warm call? Because Vicki has said you definitively want the warm, and I agree with her. If you can get it, you do it. But from your perspective, you get this, and how do you look at something? What separates it to say, I really want to have a conversation with this person, with this team? Why? What is it that draws you to that?
Well, I think there was a couple of key things there, but yes, getting the warm intro, it makes a huge difference in the receptivity of the counterparty. If you can get it, you should always try and get it. If you can't get it, I would say that your chance of getting the meeting diminishes greatly. I would say of the requests for capital or interest from Meta Capital, it's probably 1 in 10 that we actually even take a call with if it's a cold intro. Whereas if it's a warm intro, I'd say that's probably 80 to 90% candidly. And from that perspective, you got to stand out, right? Especially if it's a cold intro, you better find a way to distinguish yourself from others. And I think having those key facts that I agree. Not sending the deck, I think is it's all about timing. Obviously, you have to have the information there. You have to have the deck ready, in my opinion. But to get the initial meeting, you don't need to send the deck. I think you can give 8 to 10 relatively value add points that really identify why you should be of interest, and then capture the attention. Don't ask for too much time. If someone wants to spend more time, they'll definitely take it. From my perspective. So I think that's the thing. If it's a big market, if you have an interesting solution, and if you're realistic with what you're making as far as assertions go. To your point, we've seen situations where someone talks about a total addressable market that is not realistic. And then if you're not being truthful and you're not honest up front, you're stained, in my opinion. I mean, I don't even want to have any more discussion, because if you're not being honest about that, and even people that say they have no competitors, in large part, that cannot be true. Because if you're chasing an industry with no competitors, then you're probably not chasing the right industry or the right target, frankly. So they may not be doing a good job of it.
I was told over and over not to do it. And then, yeah, the angel investor guy, he's like, but you actually don't have direct competitors, so just do it. And I'm like, all right. So there's exceptions to every rule.
Of course. But, you're solving a problem that is a real world problem. And I would imagine there's probably someone that's tried to replicate what you're doing. They just have done a terrible job, is my guess.
Consultants. Yeah, it's all like one-off consultants. So that's why we're like, they're not direct, right?
Yeah. I think that's a big point, that, getting advice and getting good advice are two different things, because if you haven't done it, speaking from the experience, and you actually raise a point. There's absolutely no absolutes in any of this. Okay, so if you say, well, you have to do this, well, you're going to find out that you better be flexible. And it's interesting because, Vicki, I know, so we go way back, right to the beginning, which was pretty awesome watching the journey they've been on. We would think that you want to get in like a real deep dive meeting with these investors right off the bat, but that's truly not the case. That's not what you want to do, given how much time it takes. So how do you actually manage that process to weed out who's worthwhile talking to and who is not, because you don't have enough hours to go through long times with everybody. So what do you do in that?
Yeah, so for the first time I did it, the list of 85 that I had, again, the angel investor who's really coaching me through this, like, he helped me triage like which funds would probably be the best for us versus which wouldn't, because he's very knowledgeable in this space. So again, if you don't have that, you do have to spend the time and dig into them all. So then out of the 85, what I did is I ranked them like tier 1, tier 2, tier 3. And then you start with tier 3. So the ones that you really know you don't want them to invest, start pitch practicing, right? So, and this is the stuff that from Mark's side of the table, where if an investor is in tier 3 and they're getting kind of the garbage stuff, that's where you guys are getting, punched in the face, right? So it goes both ways. Like it's hard on both sides of the table, right? So you start pitching those tier 3s first, so that you can learn, okay, what are the questions? What do I need to be sharp on? What slides need to be adjusted? What of my forwardable intro didn't land? So, and then you start working your way up the list to the tier 1s. So by the time you get to the tier 1s, the ones that you want to invest because, or they invest in industrial, for us, they invest in industrial automation or deep tech, or they're generalist funds. Another thing, when you get to the top, that they're the ones you want. Another key factor too that is not really, or was never mentioned back when I first did this, except obviously by the guy who was coaching me, is fund size. Right? So know how much you want to raise. If you're raising a pre-seed or a seed round, which is what we've done, a pre-seed and a seed, you're only looking at, our first round was 3 million, our second round was 6 million. Like if you're looking at funds that are like 500 million, they're looking to cut like a $10 million check. You're too early for them. So even though they might be tier 1 funds, you would put them in your tier 3, because it's okay if you garbage pitch them. They're not going to invest right now anyway. So you need to understand like how much money you're looking for, what stage you're at relative to that. Then what is the check size that the funds typically cut? So like an $80 million fund is cutting maybe $2 to $3 million checks. That might be one that you're interested in. And you can kind of calculate. You can calculate based on what their fund size is and how many companies they invested in the last fund. To figure out if they're a fit for you or not.
Yeah,
or like it's seed.
Well, that actually gets into, so when I sat on that side, financial theory, if you have a $150 million fund, you're only making 10 to 12 investments because otherwise they're not moving the needle. So you do get that point where some of the teams think that I'm raising a little amount, which makes it easier. But in actual fact, Mark, do you think it's easier to raise small amounts or large amounts?
You got to do the same amount of work generally. So, and guys want to allocate efficiently, to your point. So from that perspective, it can be much easier to raise bigger check sizes. And
guys and gals want to allocate.
Of course. Yeah, of course. And yeah, no, I think from that perspective, you just have to be, you have to do a little bit of homework as to who you're presenting to and what they're looking for.
So how do you find that out besides just doing Google searches on this? Who's
Ask
your
other
best
founders.
source? What's that?
Ask other founders.
Okay. Are you guys open to having those discussions with each other?
Yep, I will send my list that I have. I'll scrub it a little bit, of course, with my comments, but I'm happy to send my list from my pre-seed round to anyone who asks.
So now that that we take a look at today, the markets, like obviously markets change at various times. Today, we've got an extremely active, very liquid, a lot of money chasing, in some respects, relatively few deals. So one of the things that is quite interesting, and I want both of your guys' view on this, what happens when you get faced with an investor that says, you know, I do want to place because I'm whether I write a $1 million or $10 million check, and I'm prepared to actually jack the valuation so we're not taking too much. And we've seen that going on all through the markets. What do you think about that? How do you manage your company from that perspective?
Is that a me?
Start with you.
Sure. Start with you.
Okay. Yeah, so the way to think about that is if you take that bigger check at that bigger valuation, with that amount of runway, can you meet your milestones to justify that valuation in the 2 to 3 years? And if you can't, don't do it because you're setting yourself up to fail and nobody likes a down round. Your investors won't like it, your employees won't like it. So why do it? Like why, just because it's a frothy market, like what's the point? What are you achieving, right? Especially if you have multiple term sheets and you have optionality, like why go with the really big fund just because you get to do a press release with a bigger valuation? Like, you know, kind of check yourself and be like, am I just doing this for the ego or am I doing this because it's actually going to benefit my company, right? So that's something that I think, you know, folks will easily gloss over and not think about. Then with that as well, like another point that I like to make is it depends on what you're looking for, right? So like my co-founder and I, we had loads and loads and loads of like deep experience in the industry. So we weren't looking for oil and gas investors, right? That's not, they weren't, you know, some oil and gas investor being like, hey, I can get you intros at like Chevron, Shell. I'm like, yeah, my sales guy already has all those, right? Like, I don't need that. That doesn't benefit our company. But what benefited our company, what we really needed was investors that had already been investors in scaled tech companies, like huge tech companies. That's what we needed. And so we were happy to, you know, have those conversations, and we were targeting those folks specifically to achieve getting investors on board that could help us with where our gaps were. So by doing that, so, you know, again, with the comment of don't take the big checks, it's like another thing too is a lot of, with the frothiness in the market right now, a lot of these really big funds, like the $500 million, $1 billion funds, they used to be like Series B, C kind of funds. Now they're coming into seed. But like, if you think of it, a $500 million fund invests $5 million into your company. And if you really need help learning how to scale a tech company, do you really think that that person has time or cares? Like you're not a big enough ticket on their portfolio sheet for them to really dig in and spend a lot of time with you. Whereas if you're one of 10 in like a $50 million fund, like you're going to get the help you need if that's what you're looking for. So that's another way to think of it as well.
Mark, your thoughts?
Well, there's a couple of good takeaways from what Vicki was saying, but first and foremost, I think you need to understand what you're looking for from your investor first, right? And even if you say no to the larger investment initially, those you've created a dialogue, and potentially there's an opportunity to get that capital in the future. So I don't think it's ever a bad thing to turn them down, and it creates more interest and momentum. And but the most important thing I think from raising the capital, and I think this is what Vicki did really well, is find a champion, right? And the two things that I think when you're raising capital, you need to have a lead investor, someone that's dictating the terms, and you need to have someone that's a proponent of what you're doing and helping you price properly. So I would say the most important thing when you actually get the dollars in the door is, what do you want from that investor? Because it can be just initial capital. Some people have follow-on capital, and maybe you want that, maybe you don't. Maybe that investor is only there for that one investment. And so I think you need to think about what you're wanting. Are they going to provide you network support? Are they going to provide you technology support? Is it credibility that you're looking for? So I think that's something that you have to think about, especially when you're in a situation of having multiple investors that are chasing your deal, right? Then it's a long-term relationship. It's a marriage. So make sure it's you're choosing the right partner.
And in venture, it's like a 10-year marriage. Like it's serious.
It's a long time, yeah. And you're going to have to there's going to be tough times and there's going to be good times, right? So you need to figure out someone that has the same vision and alignment and timeline that you have with your business. So if the last thing I'll say, just going back to your real question, James, do you take the bigger check or not? I think you have to be honest with yourself. And if you have a use case and you actually have deliverables that you can achieve with the bigger check, then I think you should be open to taking it. But if you can't, then you absolutely should not.
So this gets
I'd like to add something too on the champion thing. So yeah, because that is super, because I had like on just a key thing to add in, because we had the first angel investor who helped teach me, but then we had the same investor syndicate both of our rounds, right? So that's another thing too, that like it was all venture capital. They all had follow on. We chose that specifically. And then, we had one gentleman, his name's Gail Dibner. So he was very, very aggressive with us, did all the intros for all of the syndicate for the first round and did the intros for the syndicate for the second round. So his background, if you can find someone like this, like I recommend him to everyone. So he's number 9 on Forbes Midas list for Europe, and he's number 21 in Business Insider's top 100 seed investors globally. Like if you can find someone like that and get them on board, like I recommend more than anything. So that's to Mark's point on having those champions.
So Vicki, you raised something earlier, and I'm going to dig into a little bit about, because you actually prioritized who you want to see, and you went from worst to best, which I actually totally recommend, because it is a learning experience, and you only get one chance to make that first impression. So you really need to practice this. But for both Mark and Vicki, there's 3 words that are the most despised words from an entrepreneurial perspective when you're dealing with an investor. And that's the saying, "You're too early," which somebody's asked the question. It's this vague thing that means absolutely nothing. What do you do with that?
Mark, would you like to?
I have my
You've probably received more no's. You probably received more no's than I have, but I mean, I may not have, when I'm out asking for capital, I'd ask for more color and clarity, but it could be a case where that actually is true in the case of a very large fund, and you're asking for too little, and you can't use the big check that they want to actually allocate. So, but that's a case, I think, of approaching the wrong party. If it's the right fund and the right fund size for your ask, then you're missing something, candidly. And if it's going to be a throwaway meeting anyways, you might as well find out what that is from their perspective. It may not be right. Every investor is different. But, as I said, when you're looking at early stage companies, it is truly the team. So maybe you're missing someone from a team that is crucially important for the business, or maybe you're going in the wrong direction in their opinion. Doesn't mean it is the wrong direction, but it could be their opinion. So
you've heard it. What do you think of those that?
So this actually piggybacks off one of Mark's comments earlier of like, turning down an investor and then like coming back later is not a bad thing. Like they have short memories, right? And then you're able to come back and show them that like you accomplished something really cool. So like that's actually, a good thing to go back. I lost my train of thought on that one. Sorry. What was the question again?
So the year too early, like what do you do with that? Like
you're too early. Yeah. So the year too early, like again. So yeah, what Mark was saying, I wanted to make sure I piggybacked off that. Like it's a good, being too early is okay. Like they do forget and you can come back to them again later. And to add to that, it's like they like to maintain optionality. So like if they're saying you're too early, it could be that they're kind of interested but not that interested, but they don't want to tell you what they actually think because they want to keep you engaged enough that you keep them in the loop, right? So like it's not always like as irritating as you think it is really irritating, but like sometimes you actually can't get out of them like why. Like, because especially if it's coming through an email, then you email back like, why are we too early? They just won't respond, right? Like they just won't. So if you can't get,
you can flip it though. You could maybe say,
it.
is there things that we could, specific things you could work on? Maybe they give it to you, maybe they
won't
don't
respond to that either a lot of the time. Yeah, I've had that happen too, like the pure ghosting. One thing that you'll find too is that the more reputable the investor, the better they are at actually responding and giving you feedback. The crappier the investor, the more likely to ghost. So that's something that I think is really important for entrepreneurs to know, because it's very frustrating when you just get straight up ghosted. But like, look at that as a reflection of them, not you.
See, it was interesting because when I wore the investor hat, I used to actually, it was funny because I remember somebody asking, well, why do you do this? I just think sometimes, you have to tell them that dog won't hunt. Like there's just no way this thing is going to work.
Yeah.
And the problem is that as an investor, if you say that, there's this whole adage about what happens to messengers, and as everybody's heard me characterize, investors characterize the companies as lazy, arrogant, and greedy, and the companies characterize the investors as lazy, ignorant, and greedy. And so you got this whole problem going on, but you don't know that you're talking the same language. Sometimes I'm glad you actually said earlier, do not give a deck before you can have that conversation, because you can't then engage and ask those questions. But the year too early is often a euphemism for there's a fundamental problem here. It may not actually be that too early. And to Mark's point, there's only one thing that I ever cared about in investing, and that wasn't the technology. I really cared about the team. And that's a hard thing for early stage entrepreneurs to understand and present to the investors of why this team can execute. So I'm curious from both the receiver side, Mark, and you, Vicki, when you're presenting it, how do you present that team? Because ultimately, we don't care whether this technology, like ultimately the technology can work or not work, but it's the team that's going to execute. And so what is it? How do you build those teams? How do you make sure that you represent those teams to the investors that is engaging? And, you've got, as you said, from the early stage, you've got that really short paragraph and you've got only 3 things that you can get in front of them. What is it that you want to convey about that team? Not just we're what everybody says, we're a great team. I'd would love to see somebody say we're the lousiest team on the planet, but you should still invest in them.
It'd be interesting as someone who led with that.
Yeah, you might get a conversation going. So thoughts on that side?
Yeah, I can dive in on that one. This time I will not pay attention to the chat on the side, so I don't forget where I am. So in presenting the team, like I can really only elaborate on what's worked for us. The fact that we had such a deep domain experience was really what I think folks latched onto. So presenting, the fact that I've trained as a control room operator, like that my co-founder, I've got some folks coming. The fact that my co-founder is a PhD in the space, has three papers co-authored with Enbridge, really focusing on that stuff and having that leading. So have that as there's always the order of a pitch deck that you're supposed to have, but if you're a pre-seed company, lead with your team. If you have a team with epic domain experience, just lead with it, right? Don't lead with the problem, lead with why you're the right people in the space, and then be and this is the problem we found, and this is why we're tackling it.
Okay. Mark?
Yeah, I mean, I don't think we have a formulaic, you got to have this role filled and this role filled, but I think once again, it goes back to the being honest with yourself and what differentiates you relative to others and what are you trying to solve. So I totally agree that if you're solving a technical problem, and especially if you're pre-revenue, you better prove that you have an understanding of what the problem is and how you're going to solve it, and have those right technical people in place to actually accomplish that, right? I think also acknowledging that going forward, you're going to have the right oversight and guidance with respect to how you're going to structure the company, how you're going to do the raises, and that the expertise doesn't necessarily have to be on the management team. But once again, that's kind of finding a champion and being willing to accept advice, which I think is a challenge for a lot of founders, but recognizing that you don't know everything and finding the right parties and stakeholders to support you along the way is critically important. Because you can have an amazing idea or amazing technology, but if there's not adoption and you can't get it to market, that's not a good investment.
Right. Guys, thoughts going a little different. We had some people talking about, how you get that alignment with investors. Yeah, how many investors should you have, like when you're building a syndicate out? Like, do you keep all your eggs in one basket? I see one of the things I've recently seen, which was quite interesting, is from investors that they're putting out term sheets with restrictions that they're saying no syndication allowed, which is, in the normal case, I'd want to syndicate, but today I really don't have friends and I need to place the capital. So I only want to, they can go figure it out for themselves. How do you manage making sure that you get the right alignment, to pick the right investors? Like, I have actually walked away. I've had term sheets given to me, and I said, it's hard when you say, no, I will not work with you, because I know, to your point, I'm going to be having a 10-year life and it's going to be miserable if I'm working with you. So how do you figure that out? What's that? How do you, and because I know you're going to have anxiety associated with this. It's not an easy thing. How do you pick?
No, it's hard.
Saying no is hard, but could be the best deal you never did.
Yes. Especially if they blow up at you afterwards. I actually had an angel investor yell at me at a Starbucks to the point that I cried afterwards. So yeah, it's kind of after that happened, I was like, whoa, dodged a bullet there. Right. So so I think I wouldn't take a term sheet that says no syndicate, because the syndicate's super powerful, right? Having multiple folks, not only does it, whether they're on your board or not, it tempers the others, right? Because everything becomes, okay, let's all discuss and decide together, or let's get other people's opinions. And I think that that's super, super powerful. One person coming in and taking the whole round, it will kind of tip the power scales a bit too much, right? So that's something to really think about. So for me in a venture capital backed company, I wouldn't have wanted to do that. So we were happy taking the syndicate, and picking was fun. And also talking them down is tough too, when they want to put in $1 million and you're like, well, I'll take 250,000. They don't like that either. And that's harder conversations to have than you anticipate. But I think the way to, one of our advisors, he's the former CRO of Flexport, he pointed out that those are rich people problems, right? So it's not so bad. It's hard at the time, but it's it's not so bad.
Mark?
Yeah, I mean, I think it comes down to understanding who the investor is and specifically what they're bringing to the table. I mean, you're in a great position when you have multiple offers. If you're asked for no syndicate, you could consider potentially what your current capital structure is and what happens with respect to voting and board control. It is a risky situation. If there's no other options for you and you want to move your business ahead, and that's the sheet in front of you, which we're not really in that market, but we could go back there. If it's a good partnership, it could be okay, but it's risky for sure. And maybe there's ways to overcome it with paper. Perhaps there's ways that you can make sure you have, voting control or something like that, but it still could be a very acrimonious relationship if it starts going the wrong way. And that can be a challenge, no question.
Do lots of due diligence, ask for intros to their best and worst performing portfolio companies. To
your point. Okay. So they're doing due diligence on you, right? What do you think about how you do your due diligence on them? What do you do? I know. So what do you do?
So for the first round, I asked for intros to the best and worst performing portfolio companies. I actually didn't think of it myself. That goes to Root Ventures. They were like, hey, we're going to give you our best and worst performing portfolio companies for you to call. And I was like, great. And then I had the others do it as well. So that I think is a great ask. And if someone, again, if an investor shies away and is uncomfortable by that, unless you're desperate, do not go with them.
They're hiding something, just like you're hiding, to Mark's earlier point.
Yeah.
It's not a legit true relationship.
Yeah.
What are your thoughts on, like we've talked about funds that do want to wait till you get to a certain point. And so you get this, you're too early, but please stay in touch. How do you manage that? Because like you can't manage all of this stuff in a fundraise. So those that have passed, what do you do with them? Do you keep them in? Do you keep talking to them?
Oh, I keep them in a CRM. I don't keep talking, but I keep them in a CRM, a database for later.
Okay.
So Mark might be a different, I think we talked about this before, a bit of a different approach. Like I might, like, some people are like, oh, you're always fundraising. It's like, well, yes, as in I'm databasing people, but I'm not actively taking investor meetings all the time. I'm either fundraising or I'm not, in terms of like running a process.
So actually, to that end, what are the tools that you've used? What do you need to have and what do you don't need to have? So let's talk about earlier stage versus, like, you've progressed now from angel to institutional. What are the tools that have helped you, and what are the things that you found that didn't work in helping you manage those processes? Let's start with Mark, as far as that, because obviously you're investing in the companies. What are those tools that you absolutely want to see, like a database, or what do you?
Yeah, no, certainly there's a lot of CRM software programs out there. I mean, you can get away with just using Excel, like Vicki did before, earlier on in her progress. But I do think, just circling back to the earlier question, I think maintaining points of contact, they don't have to be super. They can't be too. You can be too much, for sure, right? I mean, if you approach some VC investors and you're trying to give them monthly updates, that's just gonna not even register to them. But a quarterly or an annual update, I think, makes sense. And there's a lot of good programs out there, but I think what's important is keeping in track of who've reached out to and what the feedback has been. I mean, that's the most important thing from my perspective. And providing updates to shareholders once they are shareholders, I would say, is extremely important, especially when they actually have invested. It's I would say one of my bones of contention with some investments that we've made is that you get all the promises from the counterparty, you put the capital in, and I know that oftentimes people are busy trying to move the business forward, but it is important to manage your stakeholders and stay in touch and be in communication with them and keep them apprised of what you're doing, because you can be doing a lot in the background and they may or may not know about it. And so they want to feel good that the money they've allocated is being put to good use. And frankly, if you need to go for more capital and you don't maintain good relationships, that's going to be a very tough ask. Yeah. And the easiest place to get capital is the capital you already have, just like with customers.
Absolutely.
So Mark, what do you look at? What do you look for when you're investing? What are those things that just move the needle from your perspective?
Great question. I mean, first and foremost, absolutely, especially earlier stage, is the team. I want to hear passion. I want to hear that you're realistic with your expectations and how you're going to go to market. And candidly, I think you've said in the past that investors are lazy, and I kind of agree. But if there's industry stakeholders that are supportive of what you're doing, I think that's, for me as an investor, a huge check mark. Right. And whether that's board of advisors, whether that's an end customer saying we like this idea and would be, we absolutely utilize it if it's when it's up and running. Those kind of things, to me, definitely reduce the risk profile and increase the appetite.
So, like, I would just want to dig one little deeper on that before
Sure.
I want to ask Vicki what was the biggest mistake that she made. But with yours, so when I characterize investors, having been on the side, is lazy, it's actually truly not lazy. It's that they get bombarded with hundreds, if not thousands, of different deals in a year. So you get this pile that's now in front of you, and you've got to get through it. And if you think about it, like an average fund probably sees 3 ideas a day. Okay, so which ones are floating to the top? What would you say from your perspective is team? Yeah, okay, check the mark. But are there elements of how it's presented to you? What is it that you go and say, holy God, like I really am going to dig into this? You said passion, team. Is there how it's presented to you, or and we've
For
obviously
sure.
talked about the
But
connections.
yeah, and you said it earlier, and Vicki said it too. I mean, I think for different investors, it may differ on exactly what you need to present, but articulating that there is a clear problem, a clear solution, and a profitable endpoint at some point in time for the business endeavor are all things that get me excited. I think when you can remove paths to resistance to looking at the material quickly and understanding if it's a yes or no, that is always going to be what, floats to the top of the pile as far as cream rising to the top. So the more succinct the message, the more clear the ask is, and the more clearly conveyed the problem and the opportunity, the easier it is, I think, for an investor to make a decision.
Okay, I'm going to ask Vicki a question. Anybody
one
out there
last point, James.
Okay.
I think it goes back to doing your due diligence on who the investor is and what they like. And if you can clearly articulate how your opportunity fits with what they do, I think that would help as well. It certainly helps for us.
Just a reminder, in the last 10 minutes or so that we've got, if you've got questions, throw them in the chat, and we'll try and get to them. Vicki, what do you think was in this process of capital raising was 1, 2, 3? What were the biggest mistakes that you made that you've realized going, I will not do that again? And
I think like the worst that so before I met, the 2 champions who've been really working closely with me, the worst experiences and mistakes that I made was when an investor was asking for more information, catering to them and giving them more. And this especially was a problem in Canada and Calgary, as opposed to understanding that the investor's not going about it the right way. Like they're not a high quality investor because they're giving an entrepreneur homework, and that's not what high quality investors do. So especially at early stage, right? So I think the biggest mistake I made was spending too much time talking to those investors and talking to them over months and just giving them another thing. And then they ghost you for a few months. And then they ask for another piece of information. You give it to them, then they ghost you for a few more months. It's not understanding that I just have to opt out of that behavior and not entertain it. And I think that that's a mistake that a lot of folks in Canada make, is entertaining that behavior.
Did you ever use I know some of the companies I work with use virtual databases to actually share that information. You haven't? Because
we never have. And this is another thing that's in Canada. Every Canadian founder has this big, huge, massive data room with everything in the world, and you can access it through a password on their website. And it's just I've literally raised 2 rounds of capital with I think 4 items. So a cap table, financial projections, a pitch deck. I think that was it. Actually, I think it was only 3 things. Yeah, that was it. It's only 3 things. So again, early stage versus later stage, Mark would know a lot more about this. Later stage, you're going to want a lot more than that, right? So that's another indicator that you're talking to the wrong investors, because if they're looking for more than that, or customer references is another thing, of course, and we fortunately have customers. But if an early stage investor is looking for more than that, or more than those proof points, and then you're kind of doing more work than you need to. Another thing that early stage investors asked us for that I was completely okay with was they asked for character references, right? So they wanted to speak to some of our advisors. They wanted to speak to people who were close to myself and Roger. That was totally legit. That's no extra work for us except an intro. So I think that's completely acceptable. But yeah, there's the data room thing. I think when you're pre-seed seed stage, guys, don't waste your money, don't waste your time. If somebody wants that, they're not the right investor for you.
Mark, when you make investments, what is your thought process on expectations of return? You're talking about early stage. What is it that you want to see as far as do you want to see discounted cash flows? Do you want to see cash on cash returns? How do you characterize it? And what do you think about from a portfolio perspective? What do you think is going to what do you actually think is going to happen when you make those investments? Hopefully you're going to make a lot of return, but you also know what's going to. Okay.
Yeah, I mean, I would say the potential return has to be a lot higher for earlier stage companies. So, I mean, if you go back to the traditional VC model and what the expectations are, and the failure rate versus the ones that just survive versus the home runs, I mean, I think you got to think initially it's going to at least be a 5 or 10x return to invest in just people. And as it relates back to the virtual database, I totally agree with Vicki. If it's an early stage company, absolutely not necessary. As you're starting to try and rely on your historical returns, and you have more of a track record of revenue and earnings, then that's stuff that is absolutely required from an investor to take a look at. But when you're investing in the team and an idea, I would totally agree it's not necessary. So there's my 2 thoughts there. But early stage, 5 to 10x return. If it's an established cash flow company, then you're using DCF analysis. But I don't know if there's much point in doing a DCF on a theoretical where you haven't proved out the market.
Yeah, there's nothing. And then another thing too to add to that is like our investors, like both rounds, it's like when they make investments, they need to believe that the one company that they've invested in will return the whole fund. So more than a 5-10 could be 10 to 100, right? Is what they're looking at.
Yeah, for sure. They are looking for that because typically on the VC model, you're looking at 2 are total write-offs, 6 are the zombie companies, Walking Dead, call them whatever you want to call them, and 2 are returning the make it for the entire fund. So it is that 10 plus X that you need to be able to show line of sight to. Doesn't mean you're going to get it, but you got to be able to convince somebody that you at least have a potential based on market and so forth. So I think we probably have. I'm just looking to see if we've got any more questions here from now. Vicki, you said you can share how you actually characterize and that list of investors. So if you can share that later on, I'm sure the guys will be able to get that out to everybody that wants to see it.
I can scrub one and just because there was one shared in the chat, but it's just a list of investors. It's not a list. It's not the format of how you'd set up the pipeline.
Right. And, Mark, I asked Vicki the question about biggest mistakes. I think we often learn the most from the mess ups that we make. Want to share us 1 or 2 of the things that you've seen that just gone horribly wrong against the way you thought it would play out as far as when you've made a decision to invest in, and what was it that you missed in that due diligence or in that thesis that you walked through?
Well, I think when you make the investment, I would hope that we're a good judge of character and everyone has great intentions, but the macro environment can change quickly. I would say where I think I've been most frustrated with investments that we've made as a fund, and even me personally into privates, is making sure that the communication is going to stay open. And whether you do that with paper or make it very clear to the investee company that if we're putting capital in, we expect to have a role and involvement and oversight. And when I've invested for a non-majority stake and not had that position, that's where I've had frustrations, because I think investors, if you had picked the right one, can add a lot of value to the story, whether it's using their network, opening doors, strategy, structuring, access to capital. And if sometimes you hear after the fact that something's happened and you're like, oh, I could have introduced you to XYZ company that could have given you a way better cost of capital, or this customer, and you gave up on your business, or you're not communicating. So, the biggest mistake I would say, which we don't make anymore, is we will not invest without having a role within the company. So, and that can be at minimum, that could be just a board observer seat. But if we can add more services than that, that's what we're looking to achieve, because we think we're going to help out and we're going to be the best capital that they ever spent if we have a role within the company.
Okay, so you opened it up. I'm going to go with that. Board observer versus board seat. Because obviously there's 2 sides of this coin, from the corporate perspective and from the investor's perspective. What do you what do you guys like to do? Because obviously sitting on a board is, can be a lot of work, but also you want to know what's going on. So thoughts, Vicki, observer, or you want them sitting on your board?
I think it depends on the stage of the company. So like we only took one board member when we did the pre-seed round. So just one of the 3 BC syndicate took the spot. And then we took one, because we had co-leads, we took one as an observer. And then the other in the syndicate didn't take a seat. I do have calls with, or I still do have calls with that investor every 2 weeks. And then, yeah, so with respect to our next round after that, then we had, we decided like the new lead investor took a board seat and we kept the other board seats. We actually have 4. And then now we have 2 observers. I quite like it, but again, I like it because our weakness is learning how to scale a tech company, right? And so the more tech investors I can get around the table and the more involved they are, the more they're contributing and helping work with us. So that's like, for us, it's fantastic. And I really like having them involved. And I kind of like, right now it's still very relationship based. So like, you're not having like tie breaking votes or anything like that, right? So, we treat our observers the same as our board members. Their input is weighed from just a discussion standpoint, and then we work together.
Okay. Last point, Mark, on this, and then I think we're going to turn it back over to Stephen as we come to the end of our, hopefully what was been an enjoyable and learning hour. So Mark, your thoughts, observer or actually sit on the board?
I think it depends on the opportunity, it depends on who else is there, and depends if you can add value or not, right? I mean, I think, once again, no different than the person asking for the money. You got to look in the mirror and see what you can bring to the table. And if it's an investment where you have full faith in the management team and there's credible parties there that are doing the work that you would do if you were on the board, I'm fine with an observer seat. So yeah, I'd say it's situationally dependent. I guess is the best answer I could give you.
I actually totally agree with you. Thank you, Mark. Thank you, Vicki. Very much appreciate your insight. It's super important. This is, without access to capital, we cannot move the needle for the companies. And your thoughts, and I'm sure you'd be open to having further conversations with people as we reach out to you. But I think it's important to understand, how do you actually raise the capital? And so this has been extremely important from our perspective to helping our companies. So thank you very much, Stephen.
Yeah, I'll echo those thoughts. And I think it came up a few times in the chat. People really enjoyed the discussion, enjoyed the kind of examples and the insight that you gave. I want to thank Vicki and Mark for taking the time to come here today, share some of your experience. I hope we can have you back. It's a big topic. There were some things that it feels like we just kind of scratched the surface. So maybe in the next few months, maybe later this year, we'll have you back again. We'll dig into some of the other pieces of it. For everybody on the call, don't forget, March 15th, we're going to do this one more time on a different topic. There's so much to know in building companies. I'm sure Vicki would attest. I'm sure Mark would also attest as having seen it done well and maybe poorly a couple times. So we're talking about being a CEO, how to juggle all the balls, keep them all in the air. Next month, March 15th, we'll have a great panel of folks coming up for that. That's the hour. Thank you so much to James as well for moderating. You have some great content yourself and some thoughts. You brought some of your views there and did a great job. So appreciate your contributions too. Have a great day, everybody.